You know, Louis, we didn't really plan this, but China decided to hold this major presser. So I was thinking this week it's going to be really the tone of the Fed that's going to really dictate the market direction. And then here comes the trade talks that is happening in Switzerland, and then the briefing that is expected to kick off very soon. What are your expectations? I mean, how do you see China's policy evolving in 2025?
Well, thanks for having me. It's a pleasure to be here. I think the first thing we have to acknowledge when we look at policy in China is that very often the central government points the way, points the direction, and it's local authorities and very often banks that sort of follow through. Take EVs as an example. In 2017, the Chinese government says, we want to be #1 in EVs. And that means that if I was the mayor of Shanghai or the party secretary in Guangdong, I come back to my province or my town and I say, you know what, guys? I tell my local banks, lend to my local auto producer. And before you know it, you got 130 EV producers in China, all producing great quality cars. So very often, the central government points the way, and local authorities then deliver. Now, the big question is, when it comes to the consumer, what can be done? And what you're already seeing in China is different provinces all doing different things. So today, if you live in Shanghai, you get coupons to go to the restaurants. If you live in Guangdong, you get coupons to buy appliances. If you live in Wuhan, you know, China's Detroit for all intents and purposes, there's a cash for clunkers, there's incentives for first car buyer programs. So every different regions are already doing different things. And this is partly possible because last summer, the local authorities, you know, that were all basically almost bankrupt and bleeding, et cetera, saw a lot of their debt move upwards onto the central government balance sheets. A lot of their balance sheets were cleaned up. And so now, you know, local authorities have the ability to once again expand balance sheets. And I think that's what's happening. Now, as a foreign investor, it's very frustrating because you look at the central government, you're like, okay, what are you doing? And everybody expects, oh, maybe they'll send checks like we did in the West.
Yeah.
And that's what everybody wants because, you know, as an investor, in the Western world, once everybody got checks, those checks ended up in the stock market. Stock market went parabolic. It was super exciting. But that's not going to happen in China.
But they're announcing this right before the market open. I guess it could show some sort of confidence, and it could have some market implications going forward, too.
Oh, absolutely. Look, they've called it a plan to stabilize the markets, right?
Yeah.
Not that the markets have been that unstable. When you think of, you know, how bad the trade war's been. Yes, there was a big sell-off, but there's been a rebound. The renminbi is now at the same level as it was in November. So all those talks, all the belief out there that, you know, a trade war, U.S. tariffs would lead to a weaker renminbi, a stronger dollar, I think that theory has been blown out of the water. The U.S. dollar at this stage is basically weaker against every major currency. And I think when we talk about stabilization, the more interesting development of the past week, beyond, of course, the India-Pakistan war that you highlighted, beyond the Chinese announcements that are coming in a few minutes, perhaps the more important development has been the rapid rise in the Taiwanese dollar, the Korean won, the Singapore dollar of the past 72 hours or so. I think this is important because it belies massive capital repatriation from Asian countries back to Asia. Capital repatriation, frankly, that makes sense. When you see how foreign investors get treated in the U.S. now, why wouldn't you bring money home? And the same will happen in China. Capital is going to start coming home.
And here's a cue, Marty and Louis. We've got some flashes coming from the PBOC governor. He says the world economy is full of uncertainties. We know that. He says they will resolutely safeguard China's financial market stability. And here comes the punchline. They're cutting the bank's reserve requirement ratio, which has been largely expected by the markets. And we are getting how much? By 50 basis points. They're also cutting policy interest rate. I would imagine the rate cut is not something that the market was really primed for because some people were saying that they're not going to go for it because they don't really see it working. How do you react to this?
Well, I think the main reason people thought you wouldn't get the cut in interest rates is the net interest margins at the bank are already, pretty thin. And, further interest rate cuts are going to eat into those bank net interest margins. Look, having said that, I think what's pretty obvious is that real estate has always been at the core of the China story. Part of the problems of the past 5 years is real estate prices have gone down every year. Construction has collapsed down to zero. And that one of the ways, you look around the world, one of the ways to cure a real estate downturn at the end of the day is, to make real estate more affordable. And to make real estate more affordable comes through lowering of mortgage rates. Now, mortgage rates in China have essentially almost halved in the past 3 years. They were a little bit below 6. They're now somewhere around 3. Lowering them further will mean, that young people all across China will, all those apartments that are still going empty will become more affordable. So I'm not that surprised by the interest rate cuts. Yes, it means essentially you transfer purchasing power from the banks to the consumer. Yeah, it's what China needs today.
Marty?
Hey, Louis, great to see you. I've been looking forward to this for a long time, so a pleasure having you on the show. So, whether they cut the RRR, the LPR, whatever, right? Interest rates are just a tool. The end goal is, and probably more so now, with all these U.S. tariffs on China, to get the Chinese consumer going again. I want to play you a soundbite from Rana Mitter. I'm sure you know him, right? Teaches over at the Kennedy School of Government, a Chinese historian, about the conundrum that policy conundrum China faces. Now, take a listen to this, and then we'll continue talking.
China does not want to have a freely convertible international currency because that means the control of China's renminbi is out of the hands of the Chinese Communist Party and into the hands of the international markets. But if they want to have that control of the currency, have that kind of international export capacity, then growing domestic consumption becomes much harder. And yet to get that 20-something generation confident, buying again, raising families, having more kids. Chinese are having far fewer kids than before. That's going to be a very difficult combination for the party in charge to actually manage. But that's what they need to do to get China's youth spending and confident again.
Louis, as I was mentioning, rates and monetary policy, that's just one tool, right? But to get to what they really want to do or need to do, and probably even more so now with this whole tariff situation, which is get the Chinese consumer spending again, we played that soundbite from Rana Mitter, and it's a conundrum, right? It's hard for China to have all three things at the same time. Continue running a $1 trillion plus surplus with the rest of the world, have a closed capital account, and expect to boost domestic consumption. How does China get around this conundrum? Is there a way out?
Well, look, the trade surplus is the big anomaly. To be honest, 5 years ago, China was running a trade surplus of 250, 300 billion US dollars. Running a trade surplus of $1.1 trillion means that China's trade surplus is roughly 4% of global trade total. You've never seen a trade surplus this size. So on the one hand, the trade surplus, I think, shows that China today is super, super competitive, and that, yes, to your point, consumption is disappointing. Now, logically, when you run such a large trade surplus, if I'm, let's say, making shoes for Nike and I make lots of money, what should be happening is I should be bringing my money home, buying myself a nicer house, buying myself local assets. In so doing, I bring up the exchange rate, I bring up local asset prices, which boost domestic consumption. And by boosting domestic consumption, the trade surplus abates. It's sort of how the system is, usually mends itself. The big problem today, as Professor Mender and as yourself highlighted, is that while China's super competitive, I think the confidence of households and the confidence of businesses has just been destroyed by the past essentially 5-6 years of trade wars, of COVID lockdowns, of various policies taken by the central government. And so instead of bringing this money home, increasingly what the Chinese people who are on the other side of this massive trade surplus take this money and either A, park it in Hong Kong. You've seen Hong Kong bank deposits grow by 250 billion US dollars in less than the past 2 years, which is just insane. It's so much money. Either they park it in Hong Kong, or they park it in gold, or they park it in Chinese bank deposits and Chinese bond yields continue to go to new lows. What I find interesting in this declaration by the PBOC, and granted it's early days and I haven't been able to read through everything, is we have an announcement of lower interest rates. It sounds like they might also be announcing QE because they were. I couldn't really make it out, but it sounded like they were saying they were going to be buying more bonds, but I'm not 100% sure that that's what I heard. But it sounded like it was. And if I look at your screen right now, the renminbi is essentially stable. So the stock market is liking it, but usually when you cut interest rates and you announce QE, the currency should be taking a hit, and it's not taking a hit. I find that quite encouraging.
Yeah, offshore H's are 2028 or so as we speak. Listen, Louis, this whole idea of recycling their massive surplus, right? Obviously, a lot of it is still in USTs, although they've kind of slowed down or eased back buying of USTs over the last couple of years. But more recently, right, it's gone into, as you suggested, a lot of other different places, gold, and we didn't mention crypto, so let's throw that in as well. What I'm trying to figure out, how important is it for the government to get that money out of these alternative places and into, let's say, A shares in China?
I think it's very important as a sign of signaling, of course, confidence in the local economy. Roughly 130 million Chinese people own shares, so 10% of the population. So, driving share prices higher isn't going to impact most people's pockets. Having said that, it's the stock market is an important indicator that people have of overall confidence. And when you see the stock market higher, most people, most entrepreneurs, most business people will feel a little bit better. But yes, to your point that you just made, all these surpluses that kept being recycled into U.S. Treasuries, into gold, into crypto. I would also add into Max 7. I think in recent years, the mega cap U.S. tech stocks have been a pretty obvious destination for the world's excess U.S. dollars. The big question is whether that stays. I think that up until recently, if you were a rich Chinese guy and somehow you could get your money into Hong Kong, you bought U.S. Treasuries, you were earning, let's say, 4% yield. And on top of that, if the renminbi was going down 3-4% a year against the U.S. dollar, now you're making 8% a year in renminbi terms at a time when there's no inflation in China. So that's 8% real. That's a fantastic trade. And it's a very low volatility, very easy. I think this week is upending all this, because people who were playing that carry trade in Taiwan, people who were playing that carry trade in Korea, all of a sudden they've lost 2 years worth of gains in 72 hours. All the carry trade players got carried out. I'm going to be a bit vulgar, but it's the old story of carry trades. You eat like a bird and you poop like a cow. And that's what's just happened to the Taiwanese pension funds, to the Korean insurance companies. And so now if you're a rich guy in China and you just saw the Taiwanese dollar go up 10% or so in over 2 trading sessions, do you still feel as comfortable being massively long U.S. Treasuries, being just long Hong Kong dollar bank deposits? Maybe you don't. And if at the same time, I think this is very good timing by the PBOC, because if at the same time you've got a PBOC that comes out and says, look, we want to crank up asset prices, we're going to cut interest rates, we're going to do QE, and we're going to crank up asset prices, all of a sudden, if I'm that rich Chinese guy sitting on the Hong Kong dollar bank deposits in Hong Kong, I'm thinking, you know what, maybe I should be buying some shares here. And I think that's why you're seeing the market reaction you're seeing. The CNH isn't really going down, but stocks are definitely going up.
So you're saying, so the rebound in the U.S. equities since the global meltdown, our 1-month anniversary for Squawk Box revamp here.
Congratulations.
Thank you very much. It's been impressive. So what happens going forward? I mean, some people say, look, U.S. companies have had a lot thrown at them, but they've survived COVID. The earnings are looking okay for now. You don't really see the relative upside for the U.S. over China.
No, I don't. Look, in China, what you now have is policy settings that are firmly set on driving asset prices higher. whether on the monetary policy side, and we can debate how much is being done fiscally. I know there's a lot of disappointment amongst foreign investors that more should be done fiscally. I tend to believe that fiscal policy in China happens at the local authority level, and so you don't realize it's there until it's really right there in your face. But you know that the policy settings are, tilted to the green in China. And essentially what we just heard again from the PBOC is, look, we'll keep throwing things at these markets until they go up. That's the policy settings in China. What are the policy settings in the U.S.? The policy settings in the U.S., to begin with, are much more uncertain. What you have in the U.S. to begin with is a fight between the Fed and the Treasury. They're pointing the fingers at each other. And perhaps, I've been in Asia too long, but I see that. I have PTSDs from my years of investing in Japan, where when things were going badly, the BOJ and the MOF were pointing the finger at each other, and that's never a great setup. Now, what I do know today is that the Fed is still following a mildly restrictive policy. It is doing quantitative tightening, and even as a lot of the growth data in the U.S. starts to be rolling over hard, the Fed is very much on the back foot. And then on the Treasury side, we can debate how much fiscal tightening there is in the U.S., whether Doge is just marketing, whether it's something real, but there isn't true fiscal easing in the U.S. So the policy settings could not be more opposite.
Louis, listen, a couple of minutes ago, what you were basically describing is this whole de-dollarization trend, right? And I've heard you talk about it before on numerous pods, right? It all started, this was way before the whole trade war, right? This was probably back in 2022, I think, right? Russia invades Crimea, etc. Suddenly, Vladimir Putin finds out that $300 billion of his money has been taken away and sucked up by the Europeans. It's still sitting somewhere in a Belgian bank or an account, I think, right now. And that made China go, well, hold on, right? If this can happen to Vladimir Putin's money, what about my massive holdings of U.S. Treasuries? Maybe I should think twice about buying that much, holding as much. Talk to us about that sort of transition. This has been their thinking for a while now.
You're absolutely right. And by the way, I don't think it's just Russia. I think it's Saudi Arabia. Saudi Arabia's announced that they bought $170 billion worth of gold in the past 2 years. I think it's Qatar. I think it's any country that essentially is not a democracy. And yes, to your point, I think for years, look, the U.S. has been running massive twin deficits over 10% of GDP for years and years, and essentially exporting dollars to the rest of the world, exporting little pieces of green paper. And for years, the foreigners who earned these pieces of green paper thought, you know what, I'll recycle these into U.S. Treasuries because that's how the system worked. Now, to your point, I think actually two things happened in 22. The first thing you highlighted is that the Western world said, you know what, yes, we're all equal before the law. Yes, we believe in the sanctity of property rights. Yes, you can be brown, black, yellow, Asian, whatever. You go into front of a court of law and you have the same rights as anybody else. Then we added a little asterisk to this and we said, except if you're Russian. If you're Russian, we can just take all your stuff, no due process, no courts, we just confiscate your stuff. And yes, as you pointed out, if you were Chinese, if you were Saudi, you thought, what do you mean except if you're Russian? That could be me tomorrow. If you can change the rules this way, then these assets were not what I thought they were. So that was number one. Then the second thing that happened in 22, also very important, was that President Biden went on a massive fiscal stimulus at a time when U.S. nominal GDP growth was already 7-8%, when U.S. unemployment was 4%. So all of a sudden, other foreigners that weren't worried about being confiscated, still thought these U.S. treasuries are for suckers. If you're going to do fiscal stimulus when you have nominal GDP growth of 7%, I don't want to own these anymore. And so what you saw was the Swiss National Bank, the Norwegian Pension Fund, all these guys started to say, you know what, I'm now going to just buy U.S. mega cap stocks instead of U.S. treasuries. And so all these excess dollars in the system started to go either into gold or into Max 7. Mostly those were the two asset classes where the money ended up. I think earlier this year, the idea of putting all the money in Max 7 was undermined by the release of DeepSeek. DeepSeek essentially changed the equation. the idea up until DeepSeek was that AI was going to be this golden goose, that it was going to have these huge profits. The problem is, you know this as well as anybody, once China enters a room, profits walk out. If in life you're competing with the Chinese, then you've taken a wrong turn. And so all of a sudden, China enters the AI room, and most investors decide, you know what, I think there's not going to be profits in AI anymore. I'm out of here. And the default mode became, I don't know what to do with these excess dollars, let's put them into gold, and that's where we stand.
Louis, I've been looking forward to talking to you about this whole AI explosion happening in China and this whole post this DeepSeek Sputnik sort of moment for China. You've described what's gone on with EVs in China as sort of the Hunger Games, right? Do you see the same thing happening with AI?
I do, actually. Look, I think China's in industry after industry has shown that it has a capacity to unleash unlimited amounts of human capital, and this ever more so as human capital in China continues to improve. You know, you go back 15 years ago, China was graduating 1 million university students a year, and now it's graduating 12, 13 million university students a year. So unleash unlimited amounts of human capital and financial capital. And you've seen this, you've just mentioned EVs, now you're seeing this in AI. I think if you go back to 6 months ago, the perception was that to be a player in AI, you needed to spend $50 billion a quarter. And that essentially there were only a handful of companies that could afford that bill, whether you call them Microsoft, Alphabet, etc. But China's just flipped that table. With DeepSeek, Alibaba, ByteDance, Baidu, they've all shown actually you can do it with a lot less. So yes, we now know that China will be a player in AI, and that would means that margins will get destroyed.
Yeah, and the thing you like to say is, look, in any sort of business, right, when China walks in the room, profits walk out. So that's kind of worrying there. But, so a lot of money is going to be thrown at China AI. What I'm trying to figure out is, before they get to the place where EV is right now, where you've got literally just a handful of winners who've emerged from this steaming heap, right? The Baidus of the world, etc. Are you able to identify at this early stage who potentially could be the Baidu of AI in China, or is it too early yet?
I think it's early, but look, you have some companies that obviously have a great, they're already in the race and they're already running ahead. Does that mean they finish the race first? There's still a lot of race to go. But, Alibaba's in there, Tencent's in there, all the usual suspects, the ones that are coming up on your screen right now. They have deep pockets. They have the ability to go out and recruit some of the world's best engineers in China and elsewhere. I think Tencent recently announced that they were hiring 30,000 graduates. That's, not a lot of companies can do that. And those 30,000 graduates that Tencent is going to hire are going to be the very best graduates coming out of Beida, Fudan, Tsinghua, because who wouldn't want to work for Tencent today?
Yeah, and probably also from Nanjing, where you studied. So, before we get to winners, though, these startups, they're going to create a whole bunch of jobs, right? And you've got these highly educated kids who can't find the kind of job that they want or would prefer. So, say someone with a physics degree who would probably prefer not to deliver food or go and dig ditches, right? And they're going to go, hey, great, AI startup, I'm going to join. But because of the churn and because of, so many companies that are going to, start up with a lot of excitement and then at some stage die, what happens to the Chinese labor market and those jobs and those kids then, Louis?
This is, I think, the single most important question, and I'm not sure I have a clear answer for you. Essentially, China is going through an experiment that no country's ever gone through, where it multiplies the number of kids that go through university by 10 in less than a generation. This has never happened in any country. And the big challenge, as China moves from 1 million graduates to 12, 13 million graduates, and most of these graduates want, service industry jobs. They don't want to work in a factory. They don't want to pour concrete and lay bricks. These kids, it's the challenge China has is there's not 12 or 13 million service industry workers retiring every year for these kids to sort of slot into their jobs. So China essentially needs to build from scratch very quickly a service industry to absorb all these kids. And like I said, it's never been done before.
And I do want to update some of the flashes coming out of China's securities regulator head is saying that A-share listed companies will be affected by tariffs to cope with difficulties. I would imagine it's a really bigger exposure to exports to the United States and so on. So getting that out, I do want to bring it back to the sort of the technology and the capital markets and what they're trying to do here. And just a couple of days ago, there was a report suggesting that Ant International might try again for an IPO here. And you've got that smile. Do you think it will go through? Because doesn't it sort of go against, I mean, this is just my dinner conversation from last night, but doesn't it go against the idea of common prosperity? I know that they're trying to put in some kind of a put for the stock markets, but does that work for Alibaba? And does that work for IPO?
I think that's a super important question. And look, I think the anti-IPO was pulled for many reasons, back when 2019 or 2020 when it was pulled. It was pulled for many reasons. But, one of the main ways the Chinese government, frankly, controls more or less the economy is through its control of the banking system. So having a huge competitor that is highly efficient is potentially problematic. So you could see how they would want to, at the very least, constrain Ant's growth and constrain some of the other, fintech companies' growth. It's ambivalent, right? Because on the one hand, you do want the growth of fintech, and you do want to deliver a better experience to the Chinese consumer. But at the same time, you still need to essentially pool all these Chinese savings to fund whatever growth China needs at any given time. So it's a fine line to thread. My guess is if they're going ahead with the anti-IPO is that they've by now agreed on the regulatory framework that is going to surround Ant. I think that was part of the problem 5 years ago, was that the regulatory framework was unclear, and Ant was pushing the envelope on many different fronts. It obviously got its fingers slapped. And yes, I would imagine that having an anti-IPO would be a way to signal to the market, to the rest of the world, we're back in business. Where we want the market to go higher. Come and invest your capital here. It would be a strong statement, and hopefully it happens. We'll see.
Louis, a couple of minutes left with you. I want to get to the U.S. China talks, mentioning that Secretary Bessent and also Jameson Greer, the USTR, heading to Switzerland on Thursday, meeting with Hu Feng, among other people on the Chinese side. This is likely to be, I think, just round one of these talks, right? How confident or hopeful are you that both sides are going to be able to reach some sort of deal? Because, I mean, you've noted, I think, that although, the Chinese and the Chinese economy may be a little bit more resilient than the U.S., right? If this drags on, it's lose-lose. Nobody wins from this.
Oh, of course, yeah. No, you're absolutely right. Nobody wins from... Look, most wars, nobody wins. And wars are not won by who is right, but by who is left. And the reality when you look at this trade war is the first question you have to ask yourself is who is left. Now, when you go into a war, the guys who usually win are the guys whose population is willing to make the most sacrifices. Now, I think the big problem for the U.S. is most Americans don't want this trade war. They have no interest in empty shelves at Walmart. And so the U.S. administration actually, I think, needs a deal pretty quickly, because while the Chinese population seems to buy into the idea of the trade war, the U.S. population definitely does not. So that's the first point. Second point I'd make very quickly is that it's fascinating to me that this meeting is taking place in Geneva. It really tells you how much of a breakdown in the U.S.-China relationship there is. The fact that this can't take place either in Beijing or Washington. That you have to meet on neutral ground, i.e. as if you're negotiating the end of the Vietnam War, which also happened to be in Geneva. But it's baffling to me that Chinese delegates won't fly to Washington D.C. and Bessent won't fly to Beijing. That you have to meet on a neutral ground, I think, says a lot.
And I can kind of predict President Trump looking at all these policies coming out of China and saying, look, this is working.
Yes,
it's hurting China. Louis, it's great to have you on. It's